Welcome back to EG Financials. Today we're taking a look at some interesting charts related to home ownership and consumers. And before we get started, make sure you subscribe to get more updates. And let's get started. The first chart is looking at the home ownership rate. These vertical gray bars represent recessions. And here in 2004, we can see that the home ownership rate was 69.2%. And because of the housing crisis, we saw a sharp decline in home ownership. And it bottomed out in 2016 at 62.9%. And we've seen homeownership recover. And the most recent data point for 2023 is showing that homeownership rate's at 66%, meaning that 34% of people rent. On to the next chart. Here we have real median household income. And anytime you see the word real, it indicates that it's been adjusted for inflation. And this chart shows that this data is a bit of a leading indicator for recessions. For example, if we look at 2000, where the median household income was 66,000, it peaked, and then shortly after we saw a recession. Same thing with 2007. Median household income peaked at 65,000, and shortly after we saw a recession. And the most recent data point for 2021 is showing that median household income is 70,000. And this chart is updated annually, which is why we only see 2021. The data for 2022 should be updated fairly soon. On to the next chart. This chart showing household debt service payments as a percent of disposable personal income. And this includes car loans, student loans, credit cards, mortgages, and compares it to personal disposable income. So between 2001 and 2008, consumers were a lot more leveraged than they are now. The peak was in 2007, where total household debt service equaled 13%. And since then, the consumer has been in a stronger financial position. And most recent data is showing that as of 2023, total household debt is at 9.6% of disposable personal income. Okay, on to the next chart. This chart's also looking at debt, but it's only looking at mortgage-related debt and comparing it to disposable personal income. And this chart's telling us the same thing, that the consumers for the past 5 years or so have been in a stronger financial position compared to the previous couple decades. Okay, let's continue on. This chart is showing the home equity in billions of dollars. And let me zoom in a little closer. And here we can see at the run up to the real estate crash of 2007, home equity increased, but after the crash, we saw a sharp decline and it bottomed out in 2012, where since then we've seen a great boom in the real estate market and equity has been increasing. And we did peak in around summer 2022. And since then, we've seen a bit of a pullback in real estate prices, which is why we see home equity decreasing as well. Okay, and on to the next chart where we're looking at household savings. This chart also indicates the strength of the consumer. The more savings a consumer has, the better financial position they're in. And for example, here during the pandemic, we saw consumers increase their saving rate for many reasons. One of them being they weren't sure about the economy and they wanted to save up and decrease expenses. And another reason, many businesses were shut down, so consumers didn't have the option to spend money for services and goods. But now we can start to see the consumer dip into their savings, and we're seeing this chart decrease. And that's it for today. Make sure to follow for more updates. I come out with a video daily, whether it's related to real estate, stock market, or the economy. Thanks for watching.